Hey guys, in this video we're gonna learn basic but yet important concept which is forward, future and option contract. So we are gonna see what is forward contract and we're gonna see what is future contract, and we're also going to see what is an option contract. So without any delay, let's get started. A forward contract is a customized agreement between two parties to buy or sell an asset at a specific price and a date in the future. So basically what happens in this forward contract is the contracts are negotiated between two parties and it is not traded on exchange. So the price can be negotiated, the date can be negotiated, everything can be negotiated or customized according to the buyer or seller. So the main advantage of forward contract is flexibility, as the terms can be customized to meet the specific needs of the parties involved. However, there is a downside, which is counterparty risk. So basically counterparty risk is where one party failed to fulfill the obligation under the contract. The next is future contract. A future contract is a standardized agreement to buy or sell an asset at a specific price and a date in the future. Future contracts are traded on exchange. The terms of contracts such as expiration date, contract size and delivery terms are completely standardized. Because the future contracts are traded on exchange, there is no counterparty risk involved in this future contract. And future contracts are mark to market, which means the gains and the losses are settled on the daily basis based on the current market price of the contract. And next is quite popular contract, which is option contract. An option is a financial instrument that gives the holder the right but not the obligation to buy or sell an underlying asset at a specific price and the date in the future. So in simple word, an option buyer has the right to exercise an option, but he is not obligated to exercise an option. But in forward and future contract, you are obligated to exercise, but in options you are not obligated to exercise. So the buyer of an option pays the premium to the seller for the right to buy or right to sell the underlying asset depending on the type of option. There are two types of option. One is call option, which gives the holder the right to buy of an underlying asset, and another is put option, which gives the holder right to sell an underlying asset. And in options also there are no counterparty risks. So basically forward contract, future contract and option contracts are used to manage and speculate the future price movement of an underlying asset. However, they differ in terms of customization, counterparty risk and the right or the obligation to buy or sell an underlying asset. So these are some important things to remember in forward, future and options contract. So now let us see how to buy an option contract pretty easily on Angel One. So once you log into Angel One, just scroll down a little bit and here you are able to see option called as InstaTrade, right? So just click on it. So once you click on it, you will be redirected to the InstaTrade page. So now I want to buy ICICI call options, the strike price would be of 880. So to add the ICICI 880 call option, what I'll do here, I'm able to see a plus symbol, right? I'll click on it and here I'll type ICICI 880 CE. And as you can see, the ICICI 880 CE has appeared on my screen. So I'll click on it. So once I click on it, the ICICI 800 CE has been added to my InstaTrade watch list. So here I'm able to see option called as buy. So I'll click on buy and in quantity I'll enter as one lot and I would like to buy it at a limit price of 15. So I'll enter 15 and I'll click on buy and I'll click on confirm, and that's it. My order is submitted. So now I have the right to buy this option, but I'm not obligated to buy this option. So if the ICICI is trading above 900 by the expiry, I may exercise this option, else I may not, because I'm not obligated to exercise an option. So that's how you pretty easily buy an option contract on Angel One.